Hello and welcome to Inderes TV. Today I'm in the studio with Analyst Pauli Lohi and we're going to have a brief discussion about HKFoods. Hi Paul.
Hi Pia.
So HKFoods, or HKFoods as we in Finland like to call it, their profitability has taken a major step in the right direction recently. And we've talked about this in the past as well. But what is the main reason behind this, that the development is better?
Well, I think the main reason is that they divested their Swedish, Baltic and Danish operations, and then they can focus on Finland, and they can also put all the capex to Finland, because they had kind of too many markets and too much places where they needed to invest. They didn't have capacity for that, and now they have capacity to invest well in Finland, so they have been able to improve the industrial operations and make production more efficient. That's the main reason. I think the second reason is that the cost environment has improved from what it was, for example, in 2022 when the war began between Russia and Ukraine, and that meant very steep inflation in the food sector.
Yeah,
but that's past now.
So both internal streamlining efforts and then the general market conditions have improved. But even as the situation has been getting better, operational profitability has been significantly weaker than from main Finnish competitors. What's the reason behind that?
I think it's still about the investments and capex resources. For example, Atria, that is their competitor, and not that different when you look the Finnish revenue, but very different when you see how much they are able to invest into their factories. So when you have very modern factories, then you have usually also better profitability. I think that's the main reason.
So going into that a bit deeper, what could help narrow the gap? I mean, apparently modernizing their factories, but is there something else the company could do?
Well, I think they will continue improving the profitability, doing all the small things that they can, but also probably some maybe bigger investments in the future that they haven't not yet announced, but this is capital industry, and over long term you need to invest more if you want to grow your earnings. They have had this balance sheet issue, that they have had high leverage and high financing costs. So once they can, I think they have quite stable balance sheet currently already, but there are still room to lower the financing expenses. So I think they still have to focus on that side for some years before they have maybe more capacity for big investments.
Okay. And then finally, what is our current valuation and recommendation for the company?
Well, we see the valuation rather attractive, with EV/EBIT 9 with 2025 estimates, and it is also possible that they can still improve profitability meaningfully in the following years. We have been a bit cautious maybe with that, for example, because the history where they are completely in new levels when you think about their current profitability, but it's also possible that the trend just continues and they can improve the profitability more closer to the competitors' levels. But even with current earnings, it's not expensive. It's quite attractive, and that's why we are with by recommendation.
Okay, thank you, Paul.
Thank you.
So HKFoods, attractive valuation and some movement in the right direction. If you're interested in the company, you can order notifications on our site idres.se, and if you have questions, you can ask them directly to Pauli on our forum.